Your game still boils down to chasing the green candle, doesn't it? You look at the screen, see momentum, and immediately feel the need to catch up. This is the fundamental trap most people fall into as soon as they open the terminal. You enter too late and exit in a panic when the movement suddenly stops. The market does not reward haste, it only uses it for its own nourishment. True understanding begins where superficial price observation ends. We must seek not speed, but the place of true financial commitment. Only then will you begin to see the market as it truly is.
Price is just a footprint, a tiny reflection of what has already happened. By focusing only on price, you always remain in the past, reacting to events. You need a tool that shows the weight of the decision made by major players. It must reveal the depth hidden behind the lines of the chart, and this is the key point of our research. We are looking for zones where the greatest accumulation of agreements occurred, where capital was left for a long time. The indicator we are talking about is not an oscillator. It is a vertical reflection of time. Imagine the market not as a road, but as a city with different building densities. There are wide avenues where deals are made quickly, and there are large squares where people linger. The indicator shows these squares, these places of deep agreement or disagreement. It's not about magic, it's about the architecture of the market structure, which is constantly being built and destroyed. Understanding this architecture gives you a critical advantage over those who see only colored sticks. When you know where the heaviest buildings stand, you know where the price will return. Most tools show what is happening now, but they don't show why it is happening. Real success comes from understanding the cause, not the consequence. We must change our thinking from buying the price to buying the structure. This is the transition from a speculator chasing profit to an architect who understands the foundation. Therefore, our tools should show not the movement, but the accumulation itself.
Trading is a game of waiting and precision, not reaction speed. We are not catching mice, we are hunting big prey, which requires patience. When you know the exact point where the market's strength is highest, then your actions become decisive. You stop guessing and start acting based on solid evidence. It is this evidence hidden in the depths of the structure that we will now reveal and use. The indicator visualizes the total amount of time and exchanges spent at each price level. It is not a dynamic curve, but a static histogram that grows outward. The longer this histogram, the greater the weight of that specific price level. We call these long lines zones of acceptance or pillars of weight. These zones act as magnets, constantly pulling the price back to themselves. Price always seeks places where the balance between buyers and sellers was most sustained. The pillar of weight reflects the maximum consensus on the fair value of an asset. When price moves away from this consensus, the market feels an imbalance that must be corrected. These strong levels are formed as a result of prolonged trading, where major players accumulate or distribute positions. We ignore the noise and focus only on these fundamental pivot points.
The indicator's main task is to show not just a support level, but a level of significant support. Ordinary support or resistance lines often turn out to be too thin and are easily broken. The pillar of weight is volumetric. Its width gives us a sense of its impenetrability. If price returns to the pillar, it either receives a powerful bounce or makes an important breakout. We always act only at the points where the price touches these structural elements. When price trades above the pillar, it automatically becomes a support zone protecting against a fall. If price drops below the pillar, it turns into a resistance zone, blocking further growth. This role reversal is critical and gives us clear instructions for entry. We don't guess whether it's a bounce or a breakout. We wait for the reaction. This gives us the opportunity to enter with minimal risk and a high probability of a strong movement.
Our approach is based on an understanding of collective psychology, where a sense of shared agreement prevails. Recall the ideas described by Adam Smith in The Theory of Moral Sentiments. He wrote about the human's built-in need to evaluate and correlate their actions with the opinion of society. In the market, this public opinion is expressed in the form of pillars of weight, where everyone agrees with the price. We use this collective agreement as our main guide for decision-making. We look for places where the markets spend a lot of time reaching an agreement on value. Now let's look at the opposite side, which is no less important for our game. These are the zones where the histogram has the smallest width, where time was spent quickly. These vacuum zones speak of a lack of interest or a quick rejection of the price. They serve as ideal targets for movement, as price passes through them effortlessly.
Discover the hidden levers that move the market, levers that only the top 1% truly understand. In the world of trading, we often find ourselves chasing price, forgetting the true driving forces behind it. But what if there was a book that revealed the fundamental human psychology at the core of every market movement? The Theory of Moral Sentiments by Adam Smith is not just a philosophical classic.
It is the master key to understanding the collective market psychology we've discussed, the logic behind the pillars of weight. Long before modern charts, Smith described the innate human need to evaluate and correlate actions with the consensus of the impartial spectator, the very force that manifests in the market as zones of deep agreement. This book will give you a profound understanding of why the market seeks balance, understand how collective consensus forms the strongest levels of support and resistance, the psychology of market participants, see how social judgments influence the formation of price pillars, those places where capital stays for the long term, the logic of rejection, decode why certain zones are accepted by the market while others are rejected with incredible speed. If you strive to move from a speculator chasing profit to an architect who understands the foundation of the market, this book is an essential part of your library.
It reveals not just the consequence, but the deep meaning behind market movements. Look at the market through the eyes of Adam Smith and master the true nature of its architecture. The link to the book is below the video. You must learn to clearly distinguish between two main structures: the zone of acceptance and the zone of rejection. The zone of acceptance is our magnet, the place where the price returns when it deviates too far. It is marked by a wide histogram base, indicating high trade volume. This is where our strongest stop losses and take profits are located. Price rarely breaks such a level on the first try, without significant effort and prior accumulation. The zone of rejection is a narrow neck on the indicator chart, reflecting rapid movement. This means the market did not linger at this level, did not find fair value there. These zones act like a vacuum. Once price gets there, it flies through them quickly. We use these vacuum zones as our intermediate movement targets because they offer no resistance. Your task is to determine where the price will go faster, not where it will go further. The main pillar of weight is always at the center of our attention, but the structure has many smaller pillars. We need to ignore insignificant accumulations, focusing only on those that stand out with significant width. Take the 2 or 3 widest levels on the current chart. These are your key points of strength. Mark them with horizontal lines. This will become your roadmap for the coming days. Everything that happens between these lines is just noise, a distraction from the essence of the game. Our indicator allows us to see the market in 3-dimensional space, adding the dimension of commitment. You see not only the vertical movement of price, but also the horizontal depth of accumulation. This allows us to accurately assess whether the current movement has enough fuel reserves to continue. If price bounces off a thin level, we expect a quick return to a weightier pillar. If a breakout occurs from a zone of deep accumulation, the movement will be powerful and directed. Every pillar of weight left behind turns into a zone of potential return or support. The market leaves behind beacons, so to speak, to which it can moor when a storm arrives. If you are trading above an old pillar, it protects your position from falling. If you are trading below, it becomes a ceiling that does not allow the price to rise without significant effort. We always use this structural memory of the market to place our protective orders. If price quickly approached a zone of acceptance, we prepare for a bounce, not a breakout. The pillar of weight acts as a solid wall that dampens the momentum coming from a thin zone. We wait until the price touches the widest part of the histogram or enters it slightly.
Our goal is to catch the moment when the market confirms that this level is again accepted as fair. Entry is made only after we see the formation of a candle that closes back, rejecting the pillar. This candle is proof that selling or buying has exhausted itself, meeting strong capital resistance. The stop loss is always placed just beyond the far edge of the zone of acceptance, behind the pillar's back. We give ourselves minimal space because a breach of such a level means a complete change in structure. If the market intends to pass through the pillar, it must do so immediately and decisively. If our position is knocked out, it means our initial assumption about the pillar's strength was wrong. Such an entry gives you an extremely clear stop loss, leaving no room for doubt or guessing. You know exactly how much you are risking before you enter the trade. This brings peace of mind. The distance to the pillar of weight is your measure of risk, and it should be minimal. We use the strength of the structure to reduce our protective barrier to a minimum. This allows us to work with large targets, because the initial entry point is extremely clean. Example: price was falling in a vacuum zone and reached a wide pillar of acceptance formed yesterday. Price enters the pillar, but the next candle closes green, rejecting the fall. We enter a buy after the close of this green candle, which confirms the strength. We place the stop loss 5 pips below the lowest tail of the candle that entered the pillar. We expect the price to quickly return to the next vacuum zone, where it flew through so easily. The first target for profit-taking is always at the level of the next significant vacuum zone. Price tends to fill the void it left after a rapid movement in the past. If this movement reaches the middle of the vacuum zone, we can fix part of the profit. If the movement continues, the next target becomes the edge of the next pillar of acceptance. We use structures as our entry points and as our targets. Never try to enter in the middle between pillars. This is a fundamental mistake. In the middle, the price has no support or clear reason to move in a certain direction. Your chances of success drop sharply because you are trading in a zone of uncertainty. We wait until the price itself comes to our prepared spot, like a hunter waiting for prey. Patience and a clear definition of these key structures are your main advantage.
A breakout of a pillar of weight is not an ordinary event, but a declaration of a change in market consensus. To break through a zone of deep acceptance, a large volume of new commitments is required. We never enter a breakout on the first impulse candle. This is a trap for impatient players. We wait for a return, for a retest of the newly broken pillar, which has now become a new base. This process is called a test of broken support resistance and is critical. When price returns to the pillar, it must show rejection from it, confirming the new role. If the pillar is broken upward, we expect it to act as support during the next pullback. If it is broken downward, we expect it to act as resistance, blocking the rise. Entry is made when the price bounces off the pillar, forming a rejection candle in the direction of the breakout. Example of a breakout. Price was trading in a pillar of acceptance and finally broke it downward with a strong red candle. We don't sell immediately. We wait until the price returns back to the pillar. Price returns, touches the upper edge of the pillar, but the next candle turns red again, confirming weakness. We enter a sell after the close of this confirming candle, using the pillar as an ideal pivot point. The stop loss for a breakout is placed behind the opposite edge of the pillar, providing maximum protection. Your task is to place the stop so that it is protected by the greatest weight on the chart. If price breaks back through the pillar, it cancels our breakout scenario and requires an immediate exit. It is important that the price does not linger inside the pillar again, as this would mean a return to the old consensus. The first target in a breakout is the next significant pillar of acceptance, which now becomes our target zone. Between the broken pillar and the next pillar, there is often a vacuum zone through which price should pass quickly. We expect a rapid movement to the next strong point of accumulation, where the market will find balance again. This gives us the opportunity to take a long move with a minimal risk zone. Remember, a pillar breakout is always accompanied by increased volatility, but our entry is calm. We allow other players to react to the news of the breakout, and then we enter on confirmation. This reduces the likelihood of falling into a false breakout when the price quickly returns back. Your indicator shows you exactly where this structural test should take place. Once a position is open, management boils down to moving the stop loss from one pillar to another. We don't keep the stop in one place if the market creates new zones of commitment. If price advances and forms a new, smaller pillar of acceptance above our entry point, we move the stop. The new stop is placed behind the lower edge of this newly formed smaller pillar. This allows us to protect already accumulated profit using structural changes in the market. We use new accumulations as springboards and simultaneously as protective barriers. The market constantly updates its zones of agreement, and we must move in accordance with this dynamic. An old stop loss becomes irrelevant when the price reaches a new, safer level. The goal of the movement is always to reach the next larger pillar of weight or to fill a vacuum zone. We don't exit the trade if the price just makes a small pullback. We exit when it reaches the target. If price enters the next pillar of acceptance, we must be ready for partial profit taking. Entering a pillar always causes resistance, so we reduce the size of our position before the collision. Partial fixing gives you psychological comfort and protects against a sudden reversal from the pillar. If price bounces off this new pillar, we already have protected profit, and the game continues. If price breaks the next pillar, we continue to hold the remainder of the position to the next, even further structure. Thus, each zone of acceptance serves either as a place of fixing or as a springboard for further movement.
Avoid fixing profit in vacuum zones where price moves most freely and quickly. Fixing there is limiting your potential profit and violating the logic of movement. Price seeks to pass through these zones, and we must allow it to do so until it meets real resistance. Our task is to maximize the passage through empty zones and minimize the impact on the pillars. If price remains in a new pillar of acceptance for too long and does not move further, it is a signal to exit. A long hold of price in one place after a breakout indicates the creation of a new stable balance. In such a case, we close the remainder of the position because the initial momentum has exhausted itself. Our indicator helps us identify this market fatigue. How to understand that the movement has exhausted itself if the price has not yet reached the next large pillar? The indicator tends to narrow at the tops or bottoms of a movement, showing a decrease in interest. If price makes new highs, but the width of the indicator histogram decreases, it is a sign of weakness. This suggests that the market is trading at new levels with less time and commitment. This is a pure reflection of the fact that major players do not support the current price. We use this divergence between price and structural weight to determine the ideal exit point. Our goal is to exit while the market still has inertia, but its foundation is already weakened. A change in the indicator's structure, its narrowing, is the first warning of an imminent reversal. Don't wait for the price itself to start falling. Exit based on the decrease in structural strength. Zones where accumulation was highest are the zones of strongest rejection when price breaks them. Every broken pillar of weight creates a mirror barrier behind it, attracting the price. If we broke a pillar downward, it will block any attempt to return to it. This mirror is our last, most reliable guide for keeping a position open. Full profit taking occurs when the price reaches the next large pillar of acceptance, where a tough fight is expected. Here we can close the entire position, as the struggle for this level can last for hours or days. Don't let the market take away your profit when it has already reached the final, logically justified target. We trade from structure to structure, and each new structure completes our cycle. Again, this entire game is based on our understanding of the market's common desire to reach balance. The philosophy of moral sentiments helps us understand why the market so desperately seeks its pillars of weight. These places are an expression of general agreement, and everything else is a temporary deviation from the norm. Understanding this gives you not just a tool, but a complete picture of the driving forces of price. If you are trading a bounce from a pillar, your target is the next nearest vacuum zone. If you are trading a breakout, your target is the next furthest pillar of acceptance. These two strategies, bounce and breakout, cover all possible movement scenarios. They are both entirely based on an understanding of the vertical structure of commitments. Your main task now is to stop looking at the indicator as a magic tool and accept it as a map. This map shows you where the mines are located and where the safe harbors are in the market. You stop reacting to price movement and start acting based on structural certainty. This transforms your trading from stressful guessing into calm, methodical work. Every decision to enter or exit now has a clear, visually confirmed basis. You don't need to argue with the market because the market itself draws its most important levels for you. Stick only to those points that coincide with the widest pillars of weight on your chart. Ignore all other signals that distract you from this fundamental structure. Train your eye to see not candles, but the horizontal accumulations they leave behind. Success in trading is measured not by the number of your trades, but by their quality and entry precision. Using this indicator allows you to focus exclusively on the highest quality trades. This is a game of entry precision in a zone of strong market commitment. This indicator will change your game because it will change your perception of the market itself. You will no longer see chaos. You will see an organized structure of agreements and rejections. This is the key to the peace and consistency you have been seeking in trading for so long. Start applying this knowledge immediately, noting how the price reacts to the pillars of weight. Your learning now consists of observing the price's reaction to the real weight of the market. Let the structure guide your decisions, not fleeting emotions or accidental price spikes. Only in this way can you turn trading into a stable and confident process.